Welcome back to Accounting Classroom. Today we'll learn about the make or buy decision, a common situation faced by many manufacturing companies. By the end of this class, you'll know how managers decide whether to produce a component in-house or buy it from an external supplier. A make or buy decision means choosing between manufacturing a product internally, make, or purchasing it externally, buy. The goal is to select the option with the lowest total relevant cost. For example, Foresight Manufacturing currently produces a component used in its products. It costs $500 per unit to make internally, and an outside supplier offers to sell it for $480 per unit. Should the company make or buy? At first glance, it looks cheaper to buy at $480, but not all costs are avoidable. That's where relevant cost analysis comes in. Relevant costs are those costs that will change as a result of a decision. Fixed costs that remain constant are not relevant. So, we only compare the variable or avoidable costs of making with the purchase price. Let's analyze Foresight Manufacturing's decision again, considering only relevant costs. Variable cost per unit equals $200 plus $150 plus $100 equals $450. If the part is made, total relevant cost equals $450. If the part is bought, cost per unit equals $480. Therefore, it is cheaper to make internally by $30 per unit. At sometimes, part of the fixed cost can be avoided if production stops. For instance, if $10 of fixed cost per unit can be saved, then the new make cost is $440. If no fixed cost is saved, we ignore it. Therefore, always consider only avoidable costs when making decisions. Cost is not the only factor in make or buy decisions. Management must also consider 1. Availability of production capacity, 2. Quality of supplier's product, 3. Reliability of supply and delivery time, 4. Confidentiality and security of design, 5. Impact on employees and equipment usage. Let's take another example. Annual requirement, 10,000 units. Variable cost to make equals $12 per unit. Fixed cost avoidable, $10,000 per year. Supplier price is $13 per unit. If we make, total cost equals $12 times 10,000 plus 10,000 equals $130,000. If we buy, total cost equals $13 times 10,000 equals $130,000. So the cost is the same. But if spare capacity can be used for other profitable work, buying may be better. Advantages of making. Check. Better quality control. Utilizes idle capacity. Protects design secrecy. Advantages of buying. Saves storage space. May be cheaper in short term. The final decision depends on cost comparison and strategic priorities. In summary, the make or buy decision compares internal production cost with supplier's price. Only relevant costs are considered. Fixed costs that cannot be avoided are ignored. Non-cost factors like quality, reliability, and confidentiality also matter. If this lecture helped you, please like, subscribe, and share with your classmates. In our next class, we'll study shutdown or continue decision, another key area of short-term cost analysis.